we have at the moment a debate developing between, is it inflation or are we going for a recession? As far as the Keynesians are concerned, it's a black and white. You're either, if you've got a recession, then in prospect, then you've got to just stimulate the economy. So, but they've just given up all understanding of the role of money in the economy. The monetarists claim that they know what's going on with money, hence the term monetarism. But they work effectively off a mathematical formula called the equation of exchange, which involves the quantity of money, the velocity of its circulation, the prices, and the number of transactions, which are broadly, if you like, summed up in GDP. But this actually has got nothing to do with the reality of the situation. The value of currency doesn't work off a mathematical formula. It actually works off how people see it and how they want to use it. And in that context, it's interesting to note that the level of personal liquidity, all the vibes I get, the level of personal liquidity and liquidity in business balance sheets and in the financial sector is large. It is higher probably than it has ever been. I'm talking about the money which one holds into reserve to spend at a later date. And the level is uncomfortable. And consequently, we're beginning to see people trying to get rid of it. I mean, the first sign of this was when we came out of lockdowns, when people had been unable to spend. What do? They started chasing prices of secondhand cars up through the roof, and they're still above the price of new vehicles. I mean, it's just crazy. What you have is a developing situation of people trying to dump money for goods. Now, this back in 1923 was termed the crack-up boom. Basically, the only benefit to the economy of this collapsing currency was that everybody wanted to get rid of it, so they rushed out to buy what they could, while they could, and that's the crack-up boom. And it's the point where people begin to understand that actually this money is never going to recover. I mean, the idea that the Deutschmark, the paper mark in those days, might recover was the sort of firm belief in the foreign exchanges from time to time, and also from the people. And the people in Germany really they finally gave up hope in around about April to May 1923. And at that stage, they threw in the towel on the paper mark. And the paper mark rapidly descended into complete worthlessness. We have a slightly different situation today because we're starting from a point where everybody has got this liquidity up to their necks. I'm talking about currency, but mainly bank deposits. If you look at the total of bank deposits as measured by M2 in America, it's $21 trillion. That is against a GDP of around about $22 trillion. I mean, it's almost one for one. This is crazy, absolutely crazy. And it's the reason why the Fed has outstanding reverse repos of around about $2 trillion, which is roughly 9% of that total of 21 trillion. Why do they have this? They have this. The point about a reverse repo is it takes in unwanted currency from circulation. In other words, people don't want $2 trillion, and that amount is likely to start building if you find that interest rates continue to rise. Why? Because you're getting paid sweet FA on your deposit account. Why should you hold dollars on a bank deposit account when you're getting paid almost nothing for it and prices are rising at a 9% clip? Why should you hold on to dollars when we already see that the Fed's balance sheet is in negative equity? They have just declared that they have got losses, unrealized losses on all their QE acquired bonds of $380 billion. I looked at the balance sheet yesterday, and the total equity, including undistributed income to the US Treasury, stands at 50 billion. So, 380 wipes out 50. Now, they do have a gold note on their balance sheet, which if they revalue to the current level, which they would need the permission from the US Treasury to do, and I don't know the exact terms of that gold note, that would restore the balance sheet. But if you get a further fall in bond prices, that would get wiped out very, very quickly. So, why should we be holding on to the highest level of deposit liquidity that we've ever seen? This is a dangerous situation. And then you've got, America is one thing, but and the banks there aren't horrendously overgeared. They're sort of like 11 times asset to equity. But go to Japan, over 20 times. Go to the Eurozone, over 20 times. And if you look at the share prices of the Eurozone banks, the global systemically important banks, they're all standing at huge great discounts to their balance sheet equity value. So in other words, the underbook value. Why are they underbook value? It's not because they're a good bargain. It's because people understand there is huge risk in these banks. So why, as a depositor, should you be holding deposits? Well, if you're a small depositor, you're probably relying on the government to underwrite the deposits. In the case of the Eurozone, I think something like 100,000 euros or something like that. Here we've got 85,000 pounds. So, if the bank goes belly up, then, we get bailed out by the government. But if you're a large depositor, do you really want this situation? Do you really want to have this risk? If, let's say, you've sold your house and you have got your money in your client's, your solicitor's client account, that's not covered. That goes, bang! You've lost the proceeds of your house. This is a situation which is rapidly deteriorating, and it is deteriorating the more we see pressure for interest rates to rise. And what the central banks are trying to do is they're trying to convince us that this inflation thing is temporary and we're going to return back to 2%. Therefore, we don't need to put up interest rates other than just by a tiny bit. This is, I can tell you, a very dangerous situation. It is rapidly descending into something which we may have seen the beginning of, and that is a crack-up boom. And that crack-up boom basically means that the value of the currencies just evaporates. There's no other word for it. We've been talking about this. I've mentioned the John Law experience back in France. When you get a situation where the central bank decides that it's got to support the assets, the financial assets in the system, which basically will be the policy of the Fed as it tries to not raise interest rates, then you kill the currency. And that's really the prospect of what we see.
What we're saying is when all else fails, everyone rushes to gold. That's really what...
They've got to re-educate themselves, Daryl, because we've forgotten what true money is. I've told you the legal situation, but nobody understands that really, except lawyers who specialize in banking. But this is not in general circulation, and economists, they say, oh, it's a pet rock. It's not. It is legally money. Not, currency isn't even legally money. So it's a substitute for money. And this is the amount of re-education that everybody's got to go through very, very quickly. I think is going to take gold from where it is to a far higher level, not because gold is going up, but because currency is collapsing. And that's